Oil prices have been all over the place lately. US-Iran talks, the Strait of Hormuz, the IEA slashing its demand forecast. Every headline moves the market. But here's what a lot of people miss. Oil isn't just another commodity. Most of the time, it's the first clue that the bigger economic story is changing. The old way to think about oil is pretty simple. Economy's doing well, demand goes up, trouble in an oil-producing region, supply gets squeezed, price moves. That's not wrong, but these days, it's not enough. Oil acts more like an amplifier. When it moves, it hits production costs, then inflation, then central bank thinking. If you trade across different markets, stocks, bonds, currencies, you really need to understand how that ripple works. Let's break down the chain. Oil goes up and stays up. Who feels it first? Companies. Manufacturers pay more for materials. Shipping companies pay more for fuel. Those costs pile up. Eventually, they get passed on to regular people. That's inflation. And when inflation comes in hotter than expected, central banks have to change their plans. Rate cuts get pushed back, balance sheet reduction slows down. So the chain is pretty clear. Oil, costs, inflation, interest rates. Those interest rate expectations then move just about everything else. Take growth stocks. When the market starts thinking higher for longer on rates, high growth companies get hit. Their future earnings are worth less in today's money. That's why oil and growth stocks sometimes move in opposite directions, not because one causes the other, but because both are reacting to the same big picture shift. Same idea applies to bonds and currencies. Oil pushing up inflation expectations moves treasury yields. That moves the dollar. And that moves every major currency pair. Here's something useful to keep in mind. Not all markets react at the same speed. Commodity currencies, like the Canadian dollar and the Norwegian krone, often move the moment oil twitches. Commodity markets adjust within hours. But stocks, they can take days or even weeks. Why? Because it takes time for the real earnings impact to show up in quarterly reports. If you trade across different asset classes, knowing these timing differences can actually give you an edge. Quick reality check. This framework helps you see the market. It doesn't tell you where oil is going next. Because oil still gets pushed around by lots of things. Geopolitics, OPEC plus drama, even short-term trader mood swings. Short-term moves are really hard to predict. So yeah, understand the logic. But stay humble about volatility. Professional trading isn't about catching every little price wiggle. It's about having a clear framework you can actually use and knowing exactly how much risk you're comfortable with. So here's the takeaway. Oil isn't just about supply and demand anymore. It's about inflation expectations, central bank policy, and where global money is flowing. You don't need to be an oil expert, but understanding what oil is trying to tell you, that helps you see your own